Welcome to Wall Street Beats. I'm Benjamin Bry, here with Jeff Mackey and Robert Marson. Today we're going to be talking about consumer, and we're going to talk about some pipelines. With Robert, why don't you start us off with some MLPs?
Get rich slow, guys. It's not a smoking hot sector, but this business is good and improving. The stocks are reasonably priced at 9 times EBITDA in the MLP sector. Pay your accountant to do your K1 because the valuation spreads between the C Corp now is at an all-time high, according to some Wall Street analysts. So right now, everybody knows the Williams, One Oaks of the world, those kinds of companies. And there's MLPs. Energy Transfer is one of the largest enterprise products. So that's the MLPs are the place that I'm playing in right now because the discounts are too big versus the C Corp. The balance sheets are better. This pipeline, C Corps are 4 times levered. The MLPs are only 3 times levered. That means they can lever up another turn and add a lot of EBITDA. They've been working. They worked well last year, but they didn't shoot the lights out. So I still think there's catch-up side. 2 of my favorite would be for the growth story, it's Energy Transfer, and for income, it's Plains All America Pipeline. PAA is the ticker. I've recommended this a handful of times, mostly in the 17 to 18 range because I forecasted a 10 to 13% dividend increase, and it had a 7.5% yield last year. They surprised me. They announced a 20% dividend increase. So the dividend increase was far bigger than people thought. The stock has rallied 10%, but on the 17 basis, they raised the dividend to $1.53. My guess is in 12 months, it goes to $1.65 to $1.70. So if you bought the stock with the ability to look ahead 6 quarters at 17 and change, you were buying a 9.5 to 10% dividend yield. There's no clean 9.5 or 10% dividend yields in this market today. They don't exist. In my opinion, that deserves to be priced at a 7.25 yield, 7 to 7.5. The stock, it's going to work its way higher for the next year, assuming interest rates don't take off. And it's going to be a $22, $23 stock from 19 and change. And you're going to capture an 8% dividend yield because that's what you're getting paid today. It's going to go up 10% in a year, so it's going to be closer to 9% this time next year if the stock stays the same, which it won't because it still should trade at a 7 or 7.5% dividend yield.
Yeah, look, I feel I've owned ET for a long time. It's fun to see it back at $20. It's been a long time since it was up in these neck of the woods, but I think it's much better business now. And I
just finished up Plains there, Ben. I haven't gotten ET yet. That's the sexy story. I started with the slow one, the hare. The tortoise. I like the hare. PAA, Plains All American, it's a good stock. It's 19 and change. It's also a takeover candidate. Wolf Research, which does very comprehensive energy research, is their niche, listed them as their top stock, their top pipeline company for 2025, and also said they think there's a decent chance they get bought out as part of the consolidation that's going to continue in this space. So that puts Plains aside. Now, Energy Transfer is probably the more interesting one because while Plains is mostly focused on oil transportation in Texas and in the Permian, Energy Transfer is much more related to natural gas pipelines. I think they mentioned their system delivers gas directly and indirectly to 180 power plants. And I think there's at least 80 more requests for power plants tied to data centers that they've seen arise in the last 6 months. They cover obviously the Gulf Coast area the most, but they do have pipelines that span, up into the Northeast, over to Florida, into the Southwest. So these guys are going to be able to service the data center, natural gas, electricity demand market, as well as anybody in the U.S. And they are investing heavily for that with their growth capital. Their dividend increases are chintzy. They said they're going to raise their dividend 3 to 4%. And that's their EBITDA is growing faster than that. So they're actually pulling down their payout ratio, which was already low. So these guys are teeing up the capital to invest, to grow in this new energy demand market where electricity is going to a scarcer commodity than it's been for a long time. In fact, they're building 10 power plants of their own just so they could supply their own electricity to run all their stuff and not worry about being down if the grid goes down or there's issues with shortages and spot blackouts and where power consumers, not particularly industrial, need to go offline during periods of peak demand. They don't want to be affected by that. So they're building 8 to 10 of their own gas-fired power plants. That's 9 times EBITDA, which is not that expensive. It's the high end of this company's range the last 5 years, but it used to, in the past, they traded at 12 and 13 times EBITDA. That's where most of the C Corp pipelines trade today. So it's a 30% premium in the stock if they go from their 9 to the 12. And that's where, in the past, the valuation spreads between the MLPs and the C Corps were 1 to 1.5 points. And it's now closer to 2.5 to 3 multiple points. So I think Energy Transfer, if you want a growth story that could, in the pipeline space, this is one that could morph into an institutional favorite and pick up another multiple or point or two, because the pipelines that are already C Corp have already had big moves, gotten very expensive. They now have terrible free cash flow yields. They have actual dividend yields that are 3 to 4%. And I don't know about you. I don't get jazzed about a 3.5% dividend yield. Energy Transfer is still 6.6%, which is still reasonable. So you're getting paid while they decide to invest all this capital to grow their network. And they have one other thing that's really interesting in the short run. They have a big propane business. That's when people mean natural gas liquids, not LNG, liquefied natural gas. That's a different thing. They mean propane. And the rest of the world is upgrading from wood and other things in Africa and the Middle East, poor fuels, to propane. And these guys, along with Energy Transfer, control 80% of the propane export market. And propane it's a booming commodity, actually, around the world, the demand for it. And the propane, when they were doing their numbers for the year, was in the 60 to 70% range. And it's like a lot of energy prices. It's worked its way higher, up to 87, 88 cents. So with natural gas spiking to over $4 recently and propane driving it up to almost 90 cents a gallon, the buzz on the street is there should be some really strong fourth quarter beat and raises for the nat gas heavy merchant businesses of these MLPs and pipeline companies, as well as the propane business. But there's only 2 ways to play propane in a real big way, and particularly in the export business, and that's Energy Transfer and enterprise products. So I think there's beat and raises coming for the fourth quarter for all the companies that are tied to natural gas and propane.
And I'll say one thing, and maybe you have a comment on it. Just because announced that Venture Global, a big LNG exporter, is going to do an IPO, 110 billion valuation. You have any thoughts on that, or could that maybe take some of the demand for the space? Maybe they take some of that capital. Do you have any thoughts on that one? Have you looked at it at all?
I just think anything that comes public with a high valuation that's involved in natural LNG and natural gas is good for the sector, because
that's what I would say.
It does take capital, but it also provides another comparable that gives you a benchmark that justifies paying up another 15 or 20% for this stock.
Yeah. And so I think that's right. I think that the space is clear. I mean, look, it's been a long slog from 2018 to 2020, where these were just the roughest stocks to own possible. And we've had a nice 4-year run. And now you're seeing some IPO. I mean, I think this is the biggest energy IPO in a decade. I remember the old days in 2012 to 2014, where every day there was new energy deals and MLPs were flipping up $4 or $5 on the deal. Well, those days have been sparse, let's put it that way, for the energy space for a while. So it's good to see an energy IPO.
Hey, and that's great for Chart Industries. Chart Gas GTLS, I think it hit all-time high today.
Great. Okay, so
they make the equipment that makes LNG, and that's not just a domestic play, that's a global play, because everybody around the world is going to have to find sources of electricity for data centers, unless they don't want to put them in Germany. Maybe the Germans will say, screw, we don't want data centers. We don't have enough electricity. I don't know. They're pretty
All
screwed
right.
up. They're pretty screwed up in Europe these days. They made a lot of bad, poor business decisions in the last decade.
Yeah, so Robert's been bullish on MLPs, as have I been for a while. And to be fair, if we go back to the Q4, energy was basically what consumer was last summer when Jeff was trying to start drumming up some support for those names. And Robert was on our chat, and he was like, this is the time to buy them when energy's, and no one wants them when energy's. And we've had a nice move to start the nat gas first, and most recently oil really got off the map. Yep, I think that my thesis is that this year will be more similar to 2022 than 2024. And if that's the case, energy did quite well. Other commodities actually are having a little bit of a bid to start the year as well. All right, so let's go to the other side of the rope and let's talk about a champion of industry from 100 years ago, Macy's.
RH Macy's and Sons, baby. You want boring. You want a company that's in a moribund dying industry and cranking and trading at 5 times EBITDA. You've got Macy's. 4 billion market cap somehow still. $2 billion EBITDA, 24 billion revenue. They're enormous. They're shrinking super duper slowly because they really suck at retail, but they've got a ton of real estate. Ben, I know you're an enthusiast of kind of the worst available idea. I know that you found Bath and Body Works that way when it was very unpopular and it went higher. And I'm listening to ICR and thinking, God, this Macy's is the worst damn company I've ever heard of in my life. They're a train wreck, a disaster. Maybe it's long. Maybe it's time to buy Macy's, and I need someone to talk me down or figure out what's going on there. They're so cheap. They just turned out $6.5 billion in acquisition. More about the real estate and the industry side than I do. Does someone just take these guys out and chop them up? They're begging to die.
You know, it's interesting because it's not like Macy's being troubled is new, right? This isn't a new thing. And so wouldn't you think that at this point there's been a lot of the PE types that look at the real estate, but what do you do with department store real estate? What has been like the trend, like mega churches or big fitness centers, or like what exactly, if you say there's real estate value, what is the natural?
And therein lies the rub, as Shakespeare's enthusiast would say, because the main idea from the real estate side is to have Macy's sell all the real estate and they pay rent to whoever it is on the acquisition side and spin it up that way, which it's not clear they're going to be able to make the rent payments over and over again. Yeah, and it's also not clear what the terminal number of stores that these guys have, terminal in this case meaning when they stop reducing, as opposed to terminal meaning goes out of business, because both those things are probably going to happen. But they missed again on sales this quarter because they had to pre-announce thanks to ICR, and they blamed their worst performing stores, which is just how math works. Like the worst stores probably did cause the biggest losses. I'm not sure just closing those is going to really fix what's wrong. The other thing that's going on, and what I'm really clinging for is something to believe in on the retail side, because if they really had touch with their consumers at all, you would have a buy here, but they don't. They're doing all the things that the kind of cash-starved retailers traditionally do. They're underspending on their infrastructure. They're actually shrinking online, which is just bonkers, that they're not just losing share, but their internet business is shrinking. And you can tell why when you get on the call and they're celebrating that they have 5-day delivery as like a driver of their business. Now it's like, wow, 5 days, huh? And they're stoked. It's like, look at that, 5 days. It's like you can get the cheapest Nikes and your Levi's jeans stuff that you can only find everywhere else in just 5 days from us.
They don't use drones. They got electric mules.
Yeah, they got a guy. They got this kid, Joey, that just walks from house to house. Hey, hi, Joey. Hey, Mrs. Abrams, I got your pants. There might be a turnaround there, but I'm not sure. They just turned down $6.5 billion. The question is not whether or not they could be worth more chopped up and dead than alive, because they could. A good PE shop would break off Bloomingdale's. They break off Bloom Mercury, both of which are doing okay, kind of, and are much smaller. The problem is those are only about 15% of Macy's sales and needs to get paid for. The real question there, and the real answer to whether or not this is a buy, is going to be who's going to take it out and what has given Macy's management the juice to stick around this long, because they just turned down $25 a share. And this is at 15 and they just keep taking down guidance. Their comps are nowhere near positive. It's either slow death or get bought. And your entire buy thesis is someone hits the bid and Macy's accepts a buyout.
I'm looking at the Bloomberg right now. If you go back to year-end 2020, so calendar year 21 for these guys, they had $4.8 billion in debt. Now it's down to 2.8. So they've whittled that debt load down quite a bit. They got about 500, 600 million of free cash flow and a 69-cent dividend. It's actually grown the last couple of years. So you got like a 4.5%, 5% dividend yield and debt pay down. And so that is the way you probably think about it, right? And they keep generating cash. Now, cash from operations has continued to slide. So that is an issue. And obviously, everything you're just talking about from an operationals, but it's that race of can we continue to delever and equitize the EV? And you can win that way, right? It's not exciting, but it's not. There's a lot of ways to skin a cat in the market, and that is one of them. Where
Eddie Lampert would have this thing in a million different boxes and 1,000 offshore partnerships that no one could see, that they would just be, diehard batteries? No, that's a division of ESL now. They're based in the Caribbean someplace, in Nassau. It's not that he couldn't chop these guys up. It's just who's going to go in there and do the wet work, and is management going to fight him on it in the buyout?
Yeah, Eddie Lampert's a good example. For our younger listeners, that was like in 2005, 2006, 2004, he was a pretty like big name out of Goldman, event-driven guy who bought out Sears, and it was this kind of the same kind of concept. Yeah, Kmart and Sears Holding, and it didn't end up working, but the stock ripped.
It worked out great for him, man.
Yeah.
It took enough cash out for him.
Yeah.
Holy God. He sold it one piece at a time. It was like that Johnny Cash song, man. He just sold it bit by chunk, and he'd spin off one of their stores. He would sell it for absolute top dollar, because Sears had a few great locations. He had that Santa Monica store out there.
The Santa Monica unit. Yep, exactly.
And he'd be like, we sold that for $300 million. Imagine what these other 300 Sears stores are worth. And it turns out like $1.50 was the answer. Not a ton. That's what you would do with Macy's. The department store real estate isn't getting riper. It's not becoming a more exciting investment opportunity by the day. And they don't really work as distribution centers, or else they'd be able to deliver in faster than a week. And it's hard to see where they fit in with the customers. You have that problem with the department stores in general. We'll see if Nordstrom can solve it when they're private and their cash flows quarter to quarter don't matter so much. But why do they exist? The problem with Macy's delivery being 5 days is they don't sell anything unique. Like literally nothing. A few things that you would chop them up. But for the most part, it's just they sell a little bit of Fiore. I can get Fiore to deliver me something in 2 days. A day and a half. Why would I order it from Macy's? So what's the raison d'etre for these companies? And in the case of Macy's, someone's going to buy them and chop them up. As opposed to Signet, who we heard from earlier today, also from ICR. They're a train wreck. Catherine Spurlock got that months ago on this very show, talking about that at about 110, 105. Saying that this confluence of events where you've got a meh consumer, not terrible, but not great. You've got a lot of demographics working against you, and you've got lab-made diamonds that are just going to kill the price of that industry. And sure enough, that's what's happening. You saw that stock make a huge bounce over the summer because they fired the CEO, and it turns out the CEO wasn't the one causing the lack of diamond demand. So,
is that broken? Is that broken? Because when you think about, let's just follow on from this Macy's conversation. They have a ton of real estate as their distribution model, but that requires the margin on that diamond that they would sell those diamonds for. If in Greenwich, Connecticut and Beverly Hills now, their women are okay with synthetic diamonds, well, then that's a bad, that just reminds me of Macy's, like e-commerce coming in, destroying the bricks and mortars of the bed and baths of the world. And like these guys, there's nothing that what are they going to incrementally be able to do? Now, I'm not saying short it today down 20%. I think when we look back over the last 10, 15 years, a lot of the best shorts were due to disruption, and they just couldn't adjust their business model, and they just were a business model for a different time period.
Yeah. And a lot of specialty stores have done really well in the decline of the department store age. And so I think the other model is Macy's isn't the best short on earth, but who wins if they lose? In the case of Signet, who's going to win? It's going to be other stores that move into these chains. But some industries are just so screwed for reasons that seem obvious. Signet, if you look at that over the course of years, I've shorted it before. Every time it goes down, I kick myself for not being shorted. But at the same time, it's been bouncing 50, 60% as hope just conquers all the obvious doubts. But as Catherine pointed out months ago, and is proving true today, they don't have much clarity on what their value add is. They don't have any real clear online strategy. It's where they're really going to go. The Blue Nile thing didn't work out that well. And they have jewelry stores on literally every level of the mall. which is just bonkers. Most malls probably don't need 4 places to buy cheap engagement rings.
And is there anything else that stood out from ICR? I know you list on a lot of presentations.
Dutch Bros was just killing. Dutch Brothers is absolutely smoking, which, man, I've been long that, and it was just too sweet for my taste after a while. It's just a hard one to hang on to because I am an old man yelling at clouds. They sell just terrible. My God, the sugar and fat, and just our friend Berna's down in Orlando. She picked up a Dutch Bros to do research, and it looked like just a glass of milk with sugar dumped in it. It's kids love it. They're getting same store comps that are just doing incredible. And man, never short a growth story because it's just really hard to fight them. They continue to get their same store sales are cranking out. The franchise model's working. And they're just a really young sort of taking share from Starbucks. Who benefits when other companies die? Starbucks is still focusing on whether or not they should let people use their bathrooms. No, don't let the homeless people use your bathrooms. That's that's a hack. I mean, let me push you up the learning curve there, Starbucks. That turns off customers. But yeah, and Dutch Brothers just they're growing, and that's just a model that works. That stock's pushing all-time highs. They reported great numbers. The other takeaway has been the smoking that we saw with Abercrombie and Fitch. We were talking about when we were doing the pregame thing. It's really a question of where the margins settle in on this thing. They reported yesterday that they'd grown 15% this year. Seems pretty good. Stock got smoked right back into the range, and it's just been like chunking along since last March in the like kind of 35% off the high zone to maybe 25% off, and that kind of 125 high like low 130s to 150 area. Can't get out of its own way. It's not clear it's going to be able to. It's probably just going to take more digestion. Eventually, that stock will break one way or the other, but it wasn't going to be yesterday.
Jeff, I got a question for you. Abercrombie's on my screen for down and cheap, but so is American Eagle. And that's 50 or 60% of sales with a 6% profit margin. And they do aspire to higher numbers on their slide deck. I think a couple hundred basis points of margin expansion over 2 years. And it's only about 4 or 5 times EBITDA, 10 times earnings. Now, is there hope for that? Or do they just keep delivering blah until they change out the management team?
Like 8-9 years ago, I traded Abercrombie and American Eagle in just this little basket, and they were super highly correlated. And you got a little bit of they were that closely linked both in market cap and outlook, and they went really different roads right around the pandemic. Abercrombie discovered a whole nother wave. American Eagle's still struggling for it. You still have a lot of the same characters in American Eagle that were there back in the day. I think they do need a management refresh. They also are really beholden to denim, which they haven't been able to diversify into. I thought Aerie would be a much bigger deal. I thought with Victoria's Secret's collapse that they would be able to make a lot more money with Aerie than they were eventually able to do. And that was really the hook on American Eagle. And I still think was their opportunity was to upscale their brand and create a safe, non-creepy place. If you remember Victoria's Secrets at the time, it was just appalling. And there was an excellent market opportunity that's now been filled by dozens of other companies, including a much improved Victoria's Secret that got in American Eagle's way. I think they need fresh thinking before people are really going to get interested, because they really just keep tripping over themselves a little bit as they try to get it going. What Abercrombie's done was really, you can argue that the margins are going to be a one-time thing, but they put together quarter after quarter, and that sustained kind of outperformance. Whereas American Eagle spent time, they got really involved with shipping, and they were going to hedge their shipping by buying all kinds of extra, and it's such a sweet hell.
They bought a shipping company. That tells you how focused they are.
It worked out exactly as well as you would think. Just precisely right on the screws. It's exactly what you would think would happen to a denim and underwear company if they bought a shipping operation. Didn't work out great. And you need a refresh there in the back rooms.
Oh, at half of sales, it's pretty cheap.
Super cheap and probably not going anywhere. And just this small staple that people walk past. And it would take a couple fashion cycle hits, but they really have to wash some of the stink off the history of that place.
Okay.
Yeah, cheap. Look, that Bath and Body Works was a good example. Cheap. Berna didn't have anything good to say about it, and so the narratives, which you were looking for, you're looking for people to say, I don't like it, because then there's opportunities. When fall 23, I actually bought Chewy. I know you got involved with Chewy, Jeff, and that was at like 0.6 times sales. And look, often, or what's that Druckenmiller quote? If you invest for today, you don't make any money. You got to look out. And what could change that could be it. But in general, I think the takeaway is ET looked terrible in fall or in 2020. and everybody hated it. Now it's a $20 stock and Robert still likes it. And sometimes these consumer names can look terrible and everyone can give you every reason why not to own them. Jeff's done pretty well on our show with things like Peloton and a few others that were just left for dead. And you see a couple incremental changes, and like those can be opportunities. And especially right now where we have a market that's dicey, if you will, we're not sure if the trends turned or not. And so if you already have something that's massively discounted, like a lot of the sellers are gone. You don't have like Walmart, there's a lot of people, latent sellers that could just show up, latent supply, if you will, right?
Right.
Yeah.
Down 15%. You're going to bring out a lot of sellers. The instinct is not going to be, man, this is finally my dip. It's going to be, holy shit, I held on to that way too long. Way too long.
Yeah, exactly. Like, or Abercrombie yesterday, as you mentioned, right? Like monster stock, but you get a lot of momentum guys chasing it. And if the simply the margins aren't there, even the sales were there, but the margins weren't there, next thing you're down 20%.
Just so nitpicky. And so just what the hell was anyone thinking? Watching Abercrombie down 20%, I actually bought some and I'm up $3 or woo, like nothing, just garbage picking. But anytime you're yelling at your computer, just wondering what the hell people thought was going to happen, and that's your best explanation. The Abercrombie thing, people saw the stock spike and the margins aren't there. You listen to Abercrombie, they're on the call, they're good managers, and they're thrilled about the quarter. They're excited about the year. They think they're going to be more profitable. Do they think they're going to grow? And that's the part where you really got incredulous. Of course, they're not going to grow another 25% next year. That would be an insane expectation. If management was saying that, it would be the short of all time. If the market believed it, why would anyone? So can Abercrombie make a lot more money next year? For sure they can. They're going to have all kinds of dials they can turn. Doesn't mean the stock's going to get out of its own way, but eventually there's earnings power there that they just have to lock in.
And I think that touches on a general issue we have in the markets right now with the highest allocation to stocks from domestic households and then foreigners allocations at the all-time high. And then so multiples are high and business can be good. So we can have, and we talked about it, Jeff and I did with Berna last Friday, is that what you have to watch out for is exactly this Abercrombie dynamic of business is good, but the stock is just too over its skis. So you can have a not great stock with a good business dynamic. And that's a really tricky game for a lot of people to play, because you're usually thinking, okay, if I can predict the earnings, then the stock's going to follow through. But when you have, right. and again, and I know my man Robert will agree with this, high multiple stocks are a tricky beast to play with.
Yeah, absolutely.
Yeah. And so, all right. So I think that's it for the show. And one last thing, tomorrow we have, and it's my birthday. Thank you very much, Jen.
It's a birthday. It's a birthday. Yay.
Tomorrow we have our colleague David Maris, who's been all over HIMS, which has been a great stock, and he's been long bullish. And we have a guest from HIMS House, which is a chat group that's all dedicated to HIMS. And so if you're interested in HIMS, which by the way, if you're like trading, that's a good trading stock. That thing moves around.
It's a really good trading stock.
Yeah, that is a great stock to be trading because that thing will move 10% in a day on a fart. And so it's not ET. Let me put it that way. It's the opposite stock of ET. They're both up and to the right. One just moves a lot on its way to that destination. So David will be hosting. If you're interested in HIMS, come check us out tomorrow morning, 10 a.m. Eastern. That's all we got for today. This is Ben Bry, Jeff Mackey, and Robert Marson. Take it easy, guys.
Good show, boys.
Good job, guys. All right, talk to you later. Got to run. Bye.